stability. Okay? And also, now we have macroprudential policy tools. In that sense, I think this concern for financial instability is not really the reason for giving up 2% inflation target. And let me finally, let me close my presentation by showing the Japanese experience. So this is cited from the financial system report of the Bank of Japan. And those are measures of various conditions in the financial markets, such as real estate markets and loan to GDP ratio and so on. And green means financial markets are calm. Red means that there are some concerns or too much booming in the financial markets. And as you can see, we have many reds, in the 60s. And that was, I want to go back. Go back is one more. Okay. So you have many red signs in the bubble area. And what I put my circles is some boomings in the real estate market. So there was a mini boom in 2006, between 2006 and 2008. And also we had a real estate small boom recently. Okay? And the question is, actually, when the US and Europe had real estate booms in the late 2000s, Japanese small boom was not as large. And I think the major reason was people remembered bad experience of the asset price bubbles. And I believe that policy may have contributed to that calm down of the financial markets. And finally, so this is the policy rate. So as you can see, the BOJ exited from the QE during that period. So I was talking about this period. And actually, many people, I think this has been criticized by saying that, well, exit was too early. But I think looking at the financial conditions and inflation conditions in the 2006 and 2008, I think that was not that bad decision, because if you didn't cool down the financial markets, the situation could have been worse. Okay, so thank you very much.
Thank you very much. First, let me welcome that Professor Esther Faria could make it. We are very pleased that you could arrive. Now, before you came, Mr. Guntram Wolf and Mr. Nakumara gave some introductions to the event, and I introduced the topic of our session and the speakers. And I asked the speakers to have the first two on the more country-specific. So we started with Professor Aoki, and we follow by Benoit Mongeau, and then after you will come after that. So, but let me now first thank Mr. Aoki, his very excellent presentation, highlighting the key issues with monetary policy, with the difficulties in reaching the inflation target and whether that's desirable or not. I think one very important question which I would like to come back to the discussion, so not now because time is running, is the balance sheet of the Bank of Japan, which was already very big, I would say, before Mr. Kuroda took his position, but it became even bigger. So what's the outlook for that? How that huge balance sheet issue can be orderly wind down in later years? I would like you to come back to that issue in the debate. But now let me pass the floor to Benoit Mongeau.
It's a great honor for me to be here today. I'm very moved after I read so many good papers written here in Bruegel. And I also want to say on a more personal note that Jean Pisani-Ferry is the first person who hired me as an economist. It's already a long time ago, but I was very impressed by everything he did here with many people in this room, and so I'm very happy. So I'm gonna focus more on the euro area, and so there will be some common points that the one that Kozuke mentioned about the financial system side of the transmission of monetary policy, but then move on to the labor market, and where I think we find among the most convincing, compelling arguments why inflation, and especially core inflation, in the euro area, but also more broadly in the OECD, is low currently. Okay, so everything I'm going to say is...
The point there.
Okay, this is my own views and not the views of Banque de France. So, and I apologize. Some of the comments here are in French, but French is still one of the official language, and we're in Brussels. And anyway, the pictures are very eloquent.
It's not for Bruegel, though. So Bruegel is English officially. It's okay.
I will speak only in English. So basically, the first point is that we have a recovery in the euro area. 6 million jobs have been created over the last 4 years, and you see the unemployment rate in red, which is going down. We have, I think, 16 quarters in a row of growth above potential. So we have a recovery on the real side. Okay. Now, in terms of the transmission of monetary policy to financial conditions, what you have here is in black for the euro area, and then in red for Germany, and blue for France, green Italy, and yellow for Spain. On the left-hand side, you have the interest rate at which corporations can borrow from the banking system, and in the euro area, 85% of the debt of corporations are bank loans. And on the right-hand side, you have the growth rate of the volumes of those loans. Okay, and what you see there is that from 2013 and 2014, where we have put together the current policy package in the euro system, you have a huge decline in interest rates, and especially at the periphery, and a very big recovery of the growth rates of loans. So, you know, when quantities move up and price move down, this is consistent with basically a supply shock, and basically the supply of loans has increased very markedly in the euro area. But where so our monetary policy is going to the banking sector, and there it's stimulating demand, and we've seen that jobs have recovered. The economic growth is very steady above potential for 17 quarters now. But in terms of inflation, you see that the last 4 years, this blue line here, the headline HICP has been way below our forecast, our definition of price stability, which is 2%. If you look at the expectation from the 5-year expectation from the survey of professional forecasters, which are in red, they are very well anchored. Okay, they are still very well anchored, but there is some missing inflation. So that's the mystery. So that's where I want to move to.
What's the potential growth rate? Because you mentioned 16.
The potential growth rate of the euro area, we estimate it within the euro system at 1.2, 1.23% per annum. That's what we estimate to be the potential, and the growth has been near 1.6, 1.7, or 0.4 quarter on quarter over the last 17 quarters in the euro area. So we are closing the output gap, okay, but we still have a negative output gap. That is, you know, in terms of levels, we've not recovered all the trough in output that we've gone through with the recession. So here I want to focus on labor market now, and I want to stress one dimension of labor market, which I think is extremely important. And it's a major transformation of our societies, which is very much overlooked. And that's here you have in blue core inflation, okay, and in the dotted green, I think it's green, you have the labor participation of people between 55 and 64, okay. That's the average in the OECD. This has increased you should look at the right-hand scale from 0.45 to above 60%. But if you look specifically at Germany, which is a very large, the largest member state in the euro area, you see a specific kink to this participation rate of the people who are above 55. And it was near 40% and very stable. And now it's 72%. And when does a kink happen? It starts in 2003. And 2003 is when Germany is basically passing very deep reforms of its pension system. So this feature that we see here in Germany, I stress Germany because it's very clear in terms of timing when you have this increase of participation, but you know, it's a major transformation of an economy when a participation rate of a given age class, the older workers for that matter, is moving from 39% to 72% in 15 years. That's what has happened in Germany. And the timing seemed to correspond to a response of workers to a change in pension reforms. So that's very good news for the economy. Participation is increasing. It also means that the potential output is higher. Okay? And from the point of view of central banks who always call for structural reforms, here we see a very palatable results of the economy adapting to a new situation, which is aging. Okay? So now, what in terms of the Wedge-Phillips curve? So this is estimates that I ran for this 25 OECD countries at the top and 8 euro area countries at the bottom, that's the 8 largest economies, I think, or 7 largest economies plus Finland. Okay, and the first thing that you see here is that the Phillips curve, if you look at the left-hand side, the Phillips curve is very strong. Okay, so if you take this panel data perspective, you see that wages, they increase very much with lagged inflation, and the coefficient is very significant. They also they also increase with productivity, which is what you would expect, and they decrease very significantly with unemployment. Okay, so slack on the labor market, as measured by unemployment, has a very significant effect on wage inflation. Now, if you move to the bottom, to the panel to the right, okay, there I've put 2 additional variables. One is trade openness, to try to measure whether we have an effect of globalization on inflation. And the other one is this participation rate of people above 55. And what you see there is that both in the case of OECD countries and euro area countries, you have a statistically significant effect. Okay, and the coefficient is much smaller for the euro area because that's where this variable has increased the most. Okay, so if we focus on Germany, basically, on the left here, you have the decomposition of wage. So these are 2 decomposition of wage inflation from 2000 to today, using estimates strictly on German data. Okay, so with coefficients which are close to the one I was showing you earlier for euro area countries. And on the left, you have the baseline Phillips curve specification. There you have 2 concerns, I would say, for monetary policy. One is the yellow guy, okay, the fact that past inflation, when it's been low, is dragging down wages. So it's a sign of disanchoring of inflation expectations on the labor market, okay? But this is not very large. But you also have the green guy, which is the part of wage inflation which is not explained by the model. And there you see the last 5 years, you have a negative residual, and that's also a concern. Now, if you take the expanded specification, where you also have the participation rate of the people between 55 and 64, there you see that this explained 1% lower wage inflation in Germany over the last 4 years, 5 years. Okay, so is it because those people are different? They don't have the same wage bargaining expectations. But we cannot reject that we have this effect which is dragging down wage inflation. It's a good news because it's basically, it means that potential output is higher, but it also means that that demand can be further stimulated to this level of potential. So what can we do as a central bank? What can we do as a central bank? Well, basically, we have essentially now 4 instruments, okay? So the blue here, the blue corresponds to the assets that we've purchased in the asset purchase program of the ECB, and maybe we'll know more in the next panel here with Ulrich, who will tell us more about that. We have also this lending in purple to the banking system, and I stressed earlier that we had a positive supply shock of credit market, of bank loans market in the euro area, and we are lending to the banking system at a very favorable interest rate. This is what you have in purple here. This amounts currently to 760 billion euros. And then we have our forward guidance and negative interest rates. And here in green, you have the 2 years ahead forward interest rate, which is still negative as we speak, so that our forward guidance that we're going to keep interest rate low for an extended period of time is very credible. So we keep this very stimulative, accommodating stance of monetary policy, and it will help demand in the euro area catch up with supply, and this will bring inflation back to our definition of price stability, close to 2%, below 2%. Thank you very much.
Thank you very much, Benoit, for this very, very interesting and thoughtful speech. I mean, if I understand you correctly, you are quite optimistic in a sense that sooner or later the 2% threshold or objective would be reached. But let me have 2 questions. One is that you described that there are many things which move toward that direction. One that you describe is a credit supply, positive credit supply, which helps. And the other one is the demographic changes, the increased labor force participation, which may level out, and this a kind of automatically might help to reach the 2% inflation target. But if that's the case, then why do you still need such an extensive monetary stimulus? And the second question relates more to this to these demographic changes, the increase in labor force participation, because if you have that, then I think you have to conclude that unemployment is measured very badly. Because if some people, let's say in past years, did not participate in the labor market because probably they saw that they have little chance of finding a job, so they did not register. But in fact, they are as a kind of silent, idle labor force is still there. It means also that the way we measure unemployment is very imprecise. And I think the ECB had a very excellent paper about half a year ago in which that report tried to measure the labor slack in the economy. They considered those people who wish to work but did not register officially, and also considered those people who work fewer hours than they would like to. And I think they concluded that if you consider this broader measure of unemployment, then it is almost 20%, I think 18 or something like that, instead of that time of 9 or 10% rate. So if you measure unemployment so imprecisely, then how useful to include it in regressions and use in a quantitative analysis?
You want to answer now? Are you sure?
Maybe let's also leave those answers to the general discussion, because we also have 2 speakers and we would like to have time for all. So Esther, let me pass the floor to you.
So, yeah, there were 2 excellent presentations. I'm going to have actually very few slides, and I have just a couple of points. I was too undecided. I had a number of graphs about those legs, but they were too many because I had 83 countries, so I decided not to put any. So I'll start on a very simple thing, and then I'll outline why. What I think is happening to monetary policy, and I hope I'm not getting too radical. So. So far, the monetary policy paradigm was that monetary policy could affect the output gaps. We're usually measuring the output gaps with the Nairo, and through this, it was effective inflation. Okay, and then from the Fisher parity, if the monetary policy is able to affect inflation, the nominal rate moves with the inflation expectation. Then the interest rate is simply equal to the Bruegelian rate. So this is the way we were reasoning so far, and everything was based on short-term fluctuation. So the monetary policy could only target the output gap. And as long as it was able to push demand, it was able to push inflation, and the interest rate would stay flat. Okay, so now we have two problems. The first one is that this whole paradigm is based on the fact that we know that the Phillips curve works. The Phillips curve as we know it in the short run, so where inflation is related to the output gap, and there are no other components of those legs, and where the inflation expectations are well behaved, so where we don't think that people are going to have strange inflation expectations. And we know actually this is not the truth, because it is many, many years and actually decades that academics are not facing the facts, or at least some academics, because as you see there, I'm pointing at some evidence that shows that the estimates of the traditional Phillips curve on which that paradigm was based are basically not robust. Okay, so there is a missing link there that might explain what is happening to monetary policies. The other thing that we know very well is that, true, we had some feeble recovery, but this required massive amounts of stimulus. So the question is, how massive we have to go to keep that stimulus alive. And we know on the other side that inflation is going deflationary, and that monetary policy has trouble to bring it back on the right path. So then, I think that the question goes back to the fact of what determines inflation. Because if what determines inflation basically also tells me how much leeway has the monetary policy on it, right? If inflation is just determined by the short-run output gap, then monetary policy is very powerful. But inflation is determined by something else. So let's say something that moves more on the medium run, or if we have a wrong measure of the output gap, then there might be some counteracting forces such that whatever we do with monetary policy is going to be basically a Sisyphus effort, because it's going to be counteracted by long-term forces which are driving inflation in the other direction. And so then in that respect, it's not clear that the stimulus is useful. So what are the two options that can determine inflation? The first one is that there is, mostly for people that look at the long run, a debate about what the slack is. And the second one is inflation expectation. Both of them are going to have an impact on the Phillips curve. Okay, so what the slack is, so basically, here is what Sloss was saying before. The question is, the traditional short-run measure of the output gap is the correct one, because that's the only one that the monetary authority can control, okay? Is that the only one that is determining inflation, or there is something else? And is this something else getting bigger and bigger so that, monetary policy is losing control? So there are several, there are two or three prominent long-run trends. The two most prominent is globalization and automation. So both of them affect certain things in the same direction. So they decrease cost, they produce wage moderation. Now we have a lot of papers from Acemoglu and David Otto saying that they also foster global monopolists. So there are big corporations that are, they are becoming big monopolists, and this basically reduces the markup sensitivities. So altogether, this kind of moderates inflation as well. So whatever you do on the output gap is basically going to be moderated by those two factors. The China factor, David Otto has an entire research program that is running since several years on the China factor. The other one on which I would like to put a bit more emphasis, but where I decided not to put any graph, is automation. So on this, we started 1 year ago with Gianmarco Ottaviano, who is a fellow at Bruegel, an entire data set collection on how to measure automation. So we constructed 2 index of automation, and we collected data for 83 countries. The data set is almost complete, and we have several evidence. And what we basically show is that there are several signs of labor market stagnations. We collected 6. So declining labor market shares, wage moderation, disconnect between wage and productivity growth, of course, the jobless recovery, so the fact that job destruction and job creation are moving very slowly, and underemployment, so the fact that people are either discouraged, or if they work, they are working for less hours a day work, and they are working for jobs that require lower skills than the ones for which they were educated. Those are all slacks that are not included in the NAIRO, and they are not included in any other measure of the unemployment gap. And what we find is that, in fact, robots are basically killing the labor market. And as I said, the evidence goes through 83 countries and over 2 decades. So basically what this says is that, well, you have a Phillips curve, and then you have the short-term output gap, which is what the monetary policy is trying to engineer. And then you have a giant in front of this output gap that is basically working against. So that kind of means that probably we are just running behind a monster that we have to tackle in a different way. Okay, so that's the main point of it. Now, because your session was also having some part about, what happens to the financial variables. Okay, so, in the past, I did a lot of work on risk-taking channels, so using all kind of, individual bank risk-taking. We use individual bank risk-taking measures in the work with Ignazio Angeloni, and then we had several models showing that expansionary monetary policies increases leverage and individual bank risk. I have some more recent work where I showed through VAR analysis that monetary policy can increase also systemic risk measures like delta covar and marginal shortfall and so on and so forth, to say that the impact on aggregate risk-taking is also very relevant, because eventually, if you say that it increases bank risk, then people might say, okay, so what? The monetary policy should be concerned only if expansionary policies increases aggregate risk. But now, the reason connected to what I said before, why in the end, in the medium run, the expansionary policies increases risk, rather than output, is that effectively, if there is only an increase, a minor increase of the short-term output gap, and it cannot change the slack, all that is injected in the economy, of course, goes into debt and goes into risky assets. So the question is not much how much you increase credit, but how much you increase risky credit. So that's why we need to use measures like delta covars or quantile regression, so that we are able to account for the fact that there is a shift in the riskiness of the portfolio. So, increasing credit might be good, but the question is if it goes into garbage, then it might not be good. So the first thing is that, if the monetary policy is not able to reduce the slack, then all goes into risk. And the second thing is that there is a growing amount of credit and derivatives that is not controlled by monetary aggregates. So we know certainly of the fact that through credit securities, we are able, banks are able to generate liquidity that is not linked to monetary aggregates. But there is now also a growing, growth of the disintermediation industry. So with with Monica Paiella, we have work on peer-to-peer lending using data from Prosper and Lending Club. And we see that those industries are very, very successful. And we see that more and more people are moving from the banking industry, which is actually under still the control of the central banks, through two other type of disintermediation industries. So fintech of various types, venture capital, peer-to-peer lending. Like there is this eToro platform for digital trading, and all of these are basically, they are very small, but they are growing, and they create a threat because they are basically changing also the business model of the banks. And if the business model of the banks changes and goes through the digital platforms, as it is already happening, like having big banks like BBVA buying Simple, this means that the traditional channels of deposits and the money multiplier through which monetary policy can control the financial aggregates are killed, effectively. Okay, so, I mean, there is a general trend for debanking, which might not yet be worrying, but might be important. So, to summarize, the monetary policy has troubles to control these lags, and so much of it is going into financial aggregates, but yeah, I also have troubles to go back in the slides. Okay, but there is another, actually, other people are also claiming that the reason for which the Phillips curve is flat, so monetary policy is not effective in increasing inflation. I mean, also one of the colleagues of my university, Mirko Biderolt, is saying that, but there are other people also working on those things, that the problem is about expectation formation process. So you can prove through many things that if you don't have the standard rational expectations, but you have several things like heterogeneous expectations, ambiguity aversions, then this weaken the forward guidance. So bottom line, but then perhaps in that case, the role of monetary policy might go more on communication than in increasing the balance sheet. So generally speaking, if monetary policy impact on inflation is declined, then yeah, we might want to consider a change in the mandate. I mean, first of all, we should be able to measure correctly the slack and how inflation is determined by the slack. And I mean, probably we might want to also change and bring, central banks to what was more their original motivation, that is to control financial aggregates, and so looking more into different type of financial aggregates to contain financial panics.
Well, thank you very much for this extremely thought-provoking and also quite provocative presentation and conclusions. I mean, I especially like the way you highlighted that focusing on the current measure of output gap or NAIRU is too narrow and may miss some much broader developments like globalization and automation, which can have an impact, as you described, through various ways, lowering wage moderation. Let me raise also two questions, not answering now, but maybe you may come back in the debate. Now, one is that you mentioned that you have 83 countries. I assume Japan is there. And for Japan, we have seen this low inflation since the early 1990s. And certainly at that time, perhaps the importance of globalization and automation was much lower than it is now. So can your model and your indicators also explain the low Japanese inflation rates in the 1990s and early 2000s? And the second is that you said that all of these developments led to jobless recovery and underemployment. Yet if you see, I mean, what's happening in the euro area, we still see, I think, a quite robust job creation. So certainly, I mean, job creation is not super fast, but modest job creation around 1 or 2% per year, I think is quite considerable. So how does your automation story fits with the current developments on the labor markets in the Eurozone? But as I said, let's leave all the questions to the general discussion, and now let me invite Professor Orphanides for your presentation.
Thank you, Zolt. Let me also thank Guntram and Tamotsu for the invitation to this event. Actually started studying the zero-layer bound and balance sheet policies back in 1998, motivated by what was happening in Japan. At the time, I was at the Federal Reserve in Washington, D.C., working with Esther's esteemed colleague, who's now in Frankfurt, Volker Wieland. And our task at the Federal Reserve was to see what should be done so that we could avoid the troubles that Japan was undergoing at the time. Little did we know that Japanese monetary policy would get worse before it got better. And also that the rest of the world would actually face the same problems, and some central banks would actually start making exactly the same mistakes that the BOJ was making at the time. So what I'm going to do is spend a few minutes reviewing the very basics of what happens at the zero-layer bound. Let me see if I know how to work this. Nope. Where? Oh, here. Okay. So I will talk about the zero-layer bound and quantitative easing. I will have a very, very brief comparison of three central banks, the Fed and the ECB and the BOJ, with most of my emphasis on the Bank of Japan. I want to talk slightly about the policy options at the zero-layer bound, because we don't have a whole lot of time to cover a lot of ground. About the macroeconomic costs of inaction, which I think is perhaps the biggest problem, the biggest trap central bankers can get into once they face this unknown of not having an interest rate to tool, as Kosugi mentioned earlier on. And then I want to spend a couple of minutes on what actually was the very first function of central banks. It wasn't financial stability. It was actually maintaining solid finances for the governments that they were serving. And we should perhaps talk about these things a little bit into consideration. So the zero-layer bound, I don't need to describe this chart to you, except to say that all three central banks I will be talking about have faced it. You can see the Bank of Japan. I choose the red line for the Bank of Japan. You can see zero virtually everywhere. You will see in 2001 what happened. I don't show 1991. Kosugi showed that very nicely. The BOJ first hit zero in 1999. Then they thought they were out of it, so they raised interest rates in 2000. And you can see kind of similar episode with the ECB, 10 years later on. These things have a pattern of repeating themselves. So what do you do at the zero-layer bound? How many times do you need to do this to work? Okay. So I mentioned a few things here. Some of them have been mentioned already. Let me leave the size of the balance sheet for last. The composition of the balance sheet, you can, for example, if you're a central bank, sell short-term treasury bills, buy long-term bonds, and this will have an easing of the economy. You can drive interest rates somewhat negative. Unfortunately, as long as we have currency around, you cannot really use that instrument a whole lot. You can use communications and forward guidance. Benoit actually mentioned all of these things, but I will mention that forward guidance is not an independent tool. Forward guidance is simply communicating what you intend to do with actions later on. So in terms of what you are really left with, if you want to ease policy at the zero-layer bound, it's increasing the size of the balance sheet. It's important to realize that this is an unlimited tool. There is no end to how much a monetary policy eases. If a central banker tells you that they are unable to ease policy and raise inflation, the appropriate response, in my view, is that they should resign and let someone else to do this that knows how to increase the size of the balance sheet of the central bank and deliver the goods. It's really as simple as that. So how does QE work? Let me highlight a few of the options. I guess 3 times, 4 times, okay. The point is that any time you buy things, and this is one of the most robust rules we have in economics, demand and supply, it's not very fancy. anytime you have a player who starts buying a lot of things, the prices of those things rise, as well as the prices of their substitutes. And this is really why QE works. So you start buying bonds, QE compresses long-term yields, it raises asset prices, it weakens the foreign exchange rate. There is something that hasn't been mentioned yet today that I want to stress. By actually reducing long-term yields, QE creates fiscal space and accommodates fiscal expansion, which, if you're a believer in the fiscal theory of the price level, this actually is how QE would work. And I would highlight people like Chris Sims has been suggesting that much more of this should be done exactly so that fiscal space could be created. Overall, through all of these channels, nominal aggregate demand is raised, and we can solve the accommodation problem we have at QE. However, and this is going to take me back to the title of the conference, unconventional policy comes with a lot of uncertainty. We are not used to this. If I go back 10 years ago, very few people inside central banks had studied what to do at the zero-layer bound outside Japan. In Japan, they had done it. The multiplier uncertainty is much greater still, rather than for conventional policy where we change interest rates. This is a problem. Because if you take conservative central bankers and you tell them, you know what, the right thing to do is do this action that is highly uncertain, many conservative central bankers are going to say, oh, not me. Can you find something else that is more certain? This leads to inaction. Unfortunately, historical episodes abound of this policy response. This is my interpretation of Japan, late 90s, early 2000s. This is my interpretation of the Federal Reserve in the late 1930s, for example. I have to realize here what is the appropriate response if you are dealing with multiplier uncertainty. You have to do something which is in the direction of your policy. You do some quantitative easing, for example, in the US, in the euro area, you do $1 trillion, a trillion euro. Then you learn by watching the economy whether the multiplier is correctly calibrated or not. If you find that it's not correctly calibrated, then you do more. It's very important. Why is this very important? Because if you don't do this and you wait for things to improve without doing anything. Where am I? Okay. Nope. Nope, that's not where I am. Okay. Here. Then delay in implementation of QE will eventually depress the economy slowly, will lead to what the IMF has called lowflation. I use this concept here to capture both the mild deflation that we saw in the case of Japan, where prices were around zero, and also the systematic failure in the euro area of bringing inflation up in line with the price stability inflation, having inflation that is systematically below the central bank's objective. That's very, very important to understand. If you systematically have inflation that is lower than what you told the public to expect and what the public is used to, you will de-anchor expectations to the low side. If you do that over a period of, say, 5-10 years, then you will need to do much greater easing to get the result you wanted. So inaction is costly at many levels. It leads to worse outcomes early on. It actually leads to the need for greater accommodation that would have required if the action was correct to begin with. So it's with this introduction I can show you what the different central banks have done. So here's a picture comparing the balance sheet of the central banks with a starting point before Lehman. August 2008 is equal to 100. You can see here the Bank of Japan in red was doing a tiny QE, and indeed it reduced that tiny QE it was doing, as Kosugi showed in 2006. That was a mistake in my view, by the way, but we can disagree later. What you can see here is the response since 2008 that I want you to show. Both the Fed and the ECB kind of raised their balance sheet. The ECB in 2013 made a mistake of reducing its balance sheet. In 2015, starting to increase it again. What you can tell here is that the Fed, from these three central banks, only the Fed decisively increased its balance sheet and really went all in. You can also see that they did it in steps. This is the calibration. The first wave of QE was found not to be enough, so they did more. And then they did more. The QE3 was at the very end until they were done. The ECB only in 2015 started doing this, and we're still trying to figure out, as Benoit was saying, we're going to find out soon, are they going to make yet another mistake or not? My words, not Benoit's words on this one. The BOJ is interesting that only in 2013, if you just look at this graph carefully, only in 2013, did the Bank of Japan seriously embark on quantitative easing. Up to that point, the Bank of Japan was claiming that it was easing policy, but it really wasn't easing policy. And this is another one of the elements we have to worry about the zero lower bound, the confusion about what it means to be accommodative. With interest rates at zero, it's not clear what accommodative means. If the central bank is unwilling to raise its balance sheet, then policy may be incredibly tight, even though interest rates are at zero. So why is this important to calibrate correctly? What can QE achieve? Well, QE can restore growth and raise inflation to our central bank objective. These are obvious things. QE can improve debt dynamics. I won't spend a couple of minutes on that. Let me just give you my summary of what I see so far. I think the Fed has been overall effective in its implementation of quantitative easing, and we see this. They've started tightening policy a year ago. Their inflation forecasts 1 to 2 years out, the sweet spot for monetary policy are 2%, exactly in line with the mandate. The BOJ, I actually judge effective, but with a very costly delay. And because of that very costly delay, over a decade, it's taking much longer than anticipated to bring inflation back to its target. Part of this is the incredibly slow response of inflation expectations in Japan that the BOJ has very nicely documented in policy documents that they've done last year. For the ECB, my judgment is split. The ECB policy has been very effective for a few states of the euro area and terrible for most of the states of the euro area. Now, how can you tell this differentiation? Let me see if I can show you. 10-year government bond yields. Let me start with the red line here. Since the BOJ started doing serious QE, it has brought down long-term interest rates from already low levels, around 1%, to zero. And this is the current policy. Keep the 10-year rate around to zero. You can see how effective QE has been also for selected member states in the euro area. The German yield is very close to zero as well. But you can see how the implementation of the ECB's QE has been not so good for other member states. Italy's 10-year bond is quite high. Let me spend a few minutes on what the BOJ has done exactly. And as you know, they've started doing QQE, quantitative and qualitative easing, in 2013. They've done it in 3 steps, and I really view BOJ policy since 2013 as textbook just right. You start doing QE, which they've started in 2013. Then they realized that it wasn't enough. So they said, oh, we need to do something more. And they reduced interest rates at the short end to slightly negative numbers after observing some other central banks doing this with some success. And that was constructive. And then last year, exactly a year ago, they implemented the current policy, which is QQE with YCC. That's a very catchy name, by the way, so that's very good for their policy as well. And here what I have a quote of the regime that the BOJ has been following since then. So the first paragraph is about a negative short-term interest rate, negative short-term rate at the short end of the term structure. The second paragraph is continued purchases of long-term government bonds, aiming to make sure that the 10-year yield will stay at zero. So you have a slightly sloping term structure from negative to zero, 10 years out. Okay? And the third, incredibly important, the communication that the BOJ will continue this appropriately expansionary policy until its inflation objective is raised. This combination I consider textbook perfect policy, which after years of criticizing the BOJ since 2013, I say, yes, you've got this right, continue until you get your inflation objective. What has this done, among other things? Well, among other things, this will be increasing inflation slowly but surely. But let me show you something else. The purchases of government bond have actually had another effect. They have completely diffused any concerns of debt sustainability in Japan. The BOJ has single-handedly eliminated any concerns of default by the Japanese government. You can see this in CDS markets. Here I want to show you one rendition of this. So the red line shows you gross debt in Japan. The blue line shows you gross debt excluding BOJ holdings. Now, if you're a foreign investor thinking about buying government debt, you would want to know how much of the debt the government will need to refinance. And clearly, the government doesn't have to refinance the debt that is not clearly, the government does not need to refinance the debt that is in the BOJ's hands. You can see here the blue line is showing you that the stock of the debt that actually is or is projected to be. Sorry.
Why haven't you added back reserves?
I'm sorry.
Why have you not added back bank reserves?
No, what I'm doing here is I'm showing you the debt and then debt excluding BOJ holdings. This is.
Bank reserves has gone up. The BOJ liability has gone up.
Yeah, sure. That's the balance sheet of the central bank. I showed that earlier. But we can discuss this later on. So this is the balance sheet of the central bank. Exactly the opposite side of the balance sheet is that you're diffusing completely any concerns of default, which works like magic. If you compare Japan with the other situations I have here, I had the debt dynamics. You can look at the gross debt for the US, for Germany, and for Italy. If you look at the data these days, the ECB is running its QE policy in such a unfortunate manner that it creates concerns of default for Italy. And look at the debt to GDP ratio for Italy, and look at the debt to GDP ratio for Japan. This is the difference of how you implement.
Italy's created concerns by itself.
This is how. That's true also, but most governments are creating similar concerns, and don't have me started either on the U.S. Or on Japan on the fiscal deficit. Let me actually show you the pictures of the deficits here, so you can see them. I have them somewhere. Okay, 9 is 5 times. Okay, so here. Oops. Yeah. So here you can see a comparison of the primary balance of the U.S., Japan, and for the euro area, I just have Germany and Italy to see the heterogeneity. You can see here, what I consider really peculiar and really an indication of how important it is for the central bank to run its policy correctly. The BOJ has been running massive primary deficits, and yet, because of the way that the BOJ is running its policy in the last few years, there are no concerns in Japan, which is really important. What is this due? I just want to show you two pictures to end this presentation on the importance of doing this right. Okay, so the first is to understand debt dynamics. Primary deficits are not the most important element if you're worried about debt sustainability. The most important element is the snowball effect. And I just want you to see what the BOJ has managed to do with the snowball effect in Japan since the Bank of Japan started embarking on very serious quantitative easing. So this is the right-hand side. You can see that the snowball effect was adverse for Japan. The BOJ was actually inadvertently contributing to the deterioration of debt dynamics in Japan. The black line is over the blue line. Since 2013, the Bank of Japan has managed to reverse this. And now we have a very positive snowball effect in Japan because of the way in which the BOJ is implementing its quantitative easing. The debt dynamics in Japan are actually on a very good path. You can see in the US, you didn't really have this systematic difference. Let me show you as the last slide the corresponding picture for the euro area, to the heterogeneity here. The way the ECB has been managing monetary policy, it has created a very adverse debt dynamic for Italy, which is why we have concerns, even though the primary balance in Italy is actually exceptionally good, much better than any of the other countries I've showed here. So I want to end by pointing out the following. Q is very effective, but it matters how you do this. You have to do this decisively. In the case of the Fed, it has been done decisively and it has paid off. The BOJ, we actually have a very rich 20-year period over which we've seen first the unwillingness of the central bank to do its job, only since 2013 doing it right, and since 2013 actually single-handedly diffusing debt fears in Japan, and I think leading the country to the right track. In the ECB's case, we have a reluctance and flawed implementation. It has also led to a disanchor inflation expectations, about 25 basis points reduction, by the way. Here I disagree with Benoit. Inflation expectations are disanchored in the euro area, about 25 basis points below where they should be right now. But in the case of the ECB, you have something strange that is due to the structure of the euro area. ECB policy has been incredibly effective for a few selected member states, but ineffective for most member states of the euro area. Thank you.
So, thank you very, very much again for these very thought-provoking presentations. I'm sure the audience would have many questions. Let me just raise one, but then I will open the floor to questions and comments from the floor. Namely, your little bit provocative notion of improving fiscal sustainability by quantitative easing. Because you said that there is no need for refinance the holdings by the Bank of Japan, the government bond holdings of the Bank of Japan. But I mean, this is the case only if you have the assumption that these holdings will last forever and the Bank of Japan will always roll over its holdings. Now, you know, whether this might be or will have to be the case, I mean, that future will tell. But I think this is a very important assumption, and so far, at least in Europe, we have the strong, also treaty-based notion that central banks cannot finance governments, and certainly they cannot finance them permanently. But as I said, time is running, so let me now open the floor for questions and comments, and then I will give back the floor to the panelists. Now, Guntram was the first to indicate, but I ask not just Guntram, but all of you to try to be brief. So Guntram.
Well, thank you to all the panelists, and I think we really had a rich set of very different views. I mean, on the one hand, we had, I think, Athanasios, who sort of gave monetary orthodoxy. You know, you haven't tried hard enough, and that's why you don't see the results that you would like to see. And on the other side, we had Esther, who was saying, well, basically, we are chasing the wrong thing because basically labor markets have been changing so dramatically due to automation and globalization that, you know, monetary policy essentially becomes ineffective. And I guess it would be great, I mean, a great research program to dig deeper and actually understand both from Athanasios why you believe actually it works, because I don't think the evidence that you show is very strong. I mean, what you show is basically, you claim that the US economy is healthy, and that's the reason why you at the US Fed's reaction has actually worked. But I mean, I think if you look at the US economy a little bit more closer, you will quickly agree that it's not a healthy economy. I mean, participation rate has been falling for the last 20 years, and the unemployment rate is only so low because the participation rate is so low, right? I mean, if you adjust for participation rate, the labor market in the US looks actually worse than the European labor market. And let me also echo the point that Jolt made on the central bank in Japan. I mean, you have to, of course, include the reserves, because the reserves are a liability of the central bank. I mean, they have to pay an interest to the banking system, right? And so if that, I mean, of course, if the interest rate is zero, it doesn't matter. But if interests ever go up, then, you know, this becomes a liability for the public sector again. Perhaps on Esther, if I may, and also on Benoit, I thought, Benoit, your presentation was excellent because you showed the slack, how the slack in the economy, you actually introduce a slack measure, an additional slack measure into the Phillips curve, and it seems to be very robust. But I think what would be interesting is perhaps to add a measure of immigration into the labor market, because if I think about the puzzle why wages in Germany are not increasing, I mean, you have, of course, the increase in the labor force participation among the old segment, which you showed, but you also have massive inflow of migrants from other Eurozone countries. And that needs to be a very substantial, it needs to have a very substantial effect on the labor market as well. Not just the refugees, but really the migrants from other Eurozone countries. And in a sense, that's, I mean, what we would like to see in the monetary union. I was wondering whether you had been able to look into this further. Thank you.
Thank you.
I broadly agreed with everything you said. Maybe there's a nuance. The point on reserves, I think you're right. I don't think market participants, I think correctly market participants don't view reserves as liabilities and don't view reserves as liabilities at book value. That's very important. So people who think of them as liabilities just assume they're at book value, but there's no reason why they should be at book value. They're a kind of contingent liability were bond purchases to be reversed. The other critical thing here, I think, is that, of course, the tiered reserves, which I think has been incredibly important what Japan has done, has not only revealed that they're not standard liabilities, because you can't just dictate which level of interest rate you'd want on two different JGBs, for example, if they're in the market with an interest rate. So I'm curious as to how you think, I think this issue of whether reserves are liabilities or not is actually critically important, and not a lot of thought has really gone into it. It's just a kind of default assumption, excuse the pun. With respect to Esther, I'm curious, Simon Wren-Lewis has this argument that just goes, why on earth are we worried about low wages? It just means we can run our economies faster. Why should we worry about low wages? We can just run the economy a lot faster.
If you want to start,
sorry.
Yes. You can start.
Japan is actually a very interesting laboratory for thinking about the downwardly rigid nominal wages, and so I think there should be a lot more research on that. One thing I've thought there is that the bonus system in Japan might have made downwardly rigid nominal wages a much less serious issue in Japan. But I think this is, especially with Japan, but also in the rest of the countries that have had very low inflation, I think it's time to really revisit all that research on downwardly rigid nominal wages, and with the particular question of whether bonus systems like Japan can help deal with that. There's an old book by Martin Weitzman that's actually very good called The Share Economy, where he's arguing that bonus systems can really almost fully relieve the problem of downwardly rigid nominal wages. And I think that's now, again, a very, very important question for setting inflation targets, but also just dealing with the kind of situations we're in. So I hope people revisit that research.
I have two questions. It will be quick, but they both have to do with the risks. And are we mispricing the risk, or are we hiding them somewhere else? I think the two speakers, I think it was Esther and Kosugi, made the comment that too much reserves chasing risky projects. What's wrong with that if the risk is priced correctly? Which also relates to my question to Athanasios. When you said that you reduce the default risk, well, if you ignore inflation risk, if at some point they have to take care of it, or I think as Zolt pointed out, at some point Bank of Japan has to do something with this, and the default risk will appear again. So it's neglected, we're neglecting the risk. We have not brought it down. So.
I have a question for Athanasios, and in particular, I mean, his metric for saying for which country ECB action was successful or not. His metric is how much have bond yields come down. The problem with this metric is that this very much depends which period you look at. I mean, if you look at 2012 to 2017, you would say that ECB action has been particularly effective in Italy and Spain. I mean, it has reduced the bond yields from 7% to 2%, which is much more than whatever reduction was obtained in bonds. So I think that this shows that your metric is not right. Thank you.
Thank you. And first of all, I'd like to introduce the target of the Abenomics in Japan. Of course, that the inflation, 2% inflation is the target. Also, the very important target for the Abenomics in Japan is that over 2% potential growth. Even if we achieve this target, we cannot successful to balance the budget, also that the pension system reconstruction. This is very, very important. So, but I have a different opinion by Professor over this. Actually, that I admitted that by purchasing the JGB and BOJ give the allowance to fiscal expansion. But this fiscal expansion, government spent the money in very unproductive sector, like a construction. That's the reason why that our potential growth rate is still very low, under 1% growth. So we couldn't admit it's kind of the losing discipline, the fiscal expansion. Okay, that the BOJ should advise to the government, administration to make a kind of the fiscal discipline and to increasing the potential growth rate. So that's a very, very dangerous for the BOJ to just allowance to the fiscal expansion. That's my personal opinion. Second one was because I was BOJ in 2008, and I admitted that we are very slow to expand the QE. But from the perspective of the international coordination, if BOJ adopted the drastic QE at that time, Europe, ECB couldn't enjoy kind of the exchange rate transmission mechanism by the depreciating the euro. Also, Fed couldn't enjoy that the depreciation of the US. Okay? Very simple question. How to coordinate? For next time, if we have a crisis, and every country should kind of make a drastic monetary easing, how to conduct it, this one, would be my question for that. Thank you.
Two comments on Athanasio's presentation. If I understood correctly this morning, the Bank of Japan already for 20 years doesn't achieve its objectives. The ECB is now unsuccessful for at least 4 years, and I think many people wonder what's going on with inflation. And then we have Athanasios this morning helping us out very quickly, and it's very simple. We haven't done enough, aggressively enough QE, and there's never a problem because you can do a limited QE. I must say, for such a strong assertion, I would require really more evidence. We have 3 cases, the US, the ECB, and Japan. That's 3 data points with a very general analysis. Perhaps there's more behind it, but what we heard this morning is very general. And for such a strong authority, I cannot take that as a serious empirical proof of what's being claimed. Secondly, I think, and that also relates to some of the empirical work, that we need far more a theoretical underpinning what you're actually doing in the economy once you introduce QE. That introduces a structural break that influences market functioning, or rather I should say some markets tend to disappear altogether, government bond markets, for instance. And you could easily come up with a theory that would lead to financial instability, the creation of zombie firms would create stagnating growth, and so on, and so forth. So the foundation for the claim that QE can be unlimited, I haven't heard it, and I find it rather unlikely that you could do it without creating great damage, and that all for perhaps increasing inflation by a couple of tenths of %.
I'm wondering about the causality in Athanasios' presentation. Differences between outcomes in the US, Japan, and the EU are related to differences in decisions and implementation of monetary policy. How do we distinguish the effects of differences in monetary policy from the effects of other differences? If I look at, for example, the difference between countries in the EU, well, some of them have been subject to austerity policies and others have not. That may make a huge difference. Another aspect, differences in banking systems. 3 months ago, I was sitting here on a panel saying that we need an asset management company in order to rid banks of those 1,000 billion worth of non-performing loans. Those non-performing loans, concentrated in countries like Greece and Italy, are the reason why there is no growth. If I look at your graph for the monetary base and try to relate that to sort of standard monetary aggregates, the development of the monetary base for the euro area is not very well reflected in movements of the aggregates. For instance, the long-term refinancing operation of 2011-2012, which gave a huge dent in the base, had much smaller effects on any kind of monetary aggregate that people would consider relevant, which raises a deeper methodological question. In 2008, we said that macro policy analysis has been flawed because of its lack of attention to the financial sector. Well, where's the financial sector?
Is there any other question?
Something what Lex Hochten said. I think the thing about QE is that we don't have a sound theoretical basis for knowing exactly how it works. There are 10, 15 theories that could all give you QE having an effect, and I don't doubt that it has the effect that Athanasios is talking about, but there are many, many side effects. So it's not just a multiplier uncertainty, it's a side effect uncertainty. And so in particularly, we have some evidence about what QE did as it was, but maybe double, triple the dose was the appropriate dose to get the main effect. And we really, truly don't know what the side effects of double or triple the dose are. And theory won't answer that question because there are 15 theories that can all match the data we have on QE that would have different predictions about what would happen if you had triple the dose.
So, so many questions and so short time. Now, certainly we are almost nearing the official time of our session, but probably my colleagues who organize allow me to give time to the speakers to respond, and we start the next session a little bit later, and we have a 1 hour lunch, and I think the best option is to shorten that 1 hour lunch. I hope you wouldn't mind. But I would be really curious, and think most of you would be very curious to hear the responses of our speakers. So let me ask all of you, now in a reverse order, to try to respond to as many questions as possible at an as short period of time as possible. So, but certainly no more than 5 minutes each, and I will check the time now. So, Mr. Orfanides.
Thank you.
You have 5 minutes.
Is this 5 German minutes or 5 Greek minutes?
I'm warning them.
German.
I'm warning them.
Belgium minutes. Belgium.
So it should at least be proportional to the questions addressed, I think. Let me start with the reserves, and if I forget any questions, please approach me during the break. So the reserves are very different, and QE has a feature. It's not a bug; it's a feature that it's equivalent financial repression, which is defined as reducing the cost of financing for government debt. That's the feature I was emphasizing for the fiscal dynamics. Regarding reserves, they can be remunerated at below market interest rates. This effectively is one of the ways to tax the financial system, which has been done throughout history by central banks. One may also wish to consider the introduction of reserve requirements in the game, but the one I'd like to say is that the concern that unwinding QE is something that has to be very critical, or that we are at risk of monetary financing. We are not. Nothing that I mentioned has anything to do with monetary financing. Everything I mentioned has to do with a central bank meeting its primary mandate, which is price stability in all of the central banks. In terms of historical experience, let me just remind you, we have the Fed QE experience from the 1930s that I've written about. That was unwound not by reducing the balance sheet, but by ensuring that nominal income would grow at a normal pace. If you have a 2% pace and you have a 2% real output growth, you're growing nominal income at a 4% rate. That actually is enough to reduce the balance sheet over a 20-year period. You do it slowly, it's not monetary financing, and you are ensuring health in the economy. Let me go to Lex. Just to remind you, Lex actually gave such a wonderful description of what I described as the conservative central banker. 3 data points are not enough to be definitive, yes. It doesn't mean you should do nothing, which is the alternative. If you are missing your inflation objective, which in the case of the ECB is the primary mandate of the ECB, doing nothing is not an option. It's not even legal for the ECB to do nothing. The question is what to do to meet your price stability objective, and there I agree, minimizing the risks you have. This is why in the very first study I did on this with Volker Wieland, we actually had the element of there are side effects, and this is why you wouldn't triple the balance sheet if you have to. You would only double the balance sheet, and then see what the side effects are, taking these side effects into account. In terms of alternative differences, it's not just monetary policy, it's also other things that Martin mentioned. I absolutely agree. The central bank should internalize all of those other differences and then do what is necessary to hit its primary mandate. So if we have more fiscal austerity, for example, we did that in the euro area relative to the US or Japan, then the ECB should have done even more, as a matter of fact. So I think it's pretty clear how we can do these things. Labor markets, not my thing, but I will mention this, that I don't think we should be judging monetary policy by what the participation rate is or what potential outputs is doing. In my work on traditional monetary policy, I emphasize that we should not be judging monetary policy by looking at real variables at all. I think we should be quite orthodox on this. The central bank delivers price stability defined as the inflation rate that is trying to hit, not anything else. On downward rigidity in Japan, I should mention that there was actually downward rigidity in Japan in the 1990s. In the early 2000s, it was one of the puzzles at the BOJ, how much is there, what to do about it, but with a decade or more of no inflation, then downward rigidity has effectively disappeared to a large extent. So downward rigidity is endogenous in that sense, much like inflation expectations are. Stavros, you talked about the proper valuation of risks. I fully agree, and this is where it gets really tricky. When it comes to government bond markets, much of what is perceived as default risk is due to the behavior of the central bank. In government bond markets, as we know, we face multiple equilibria that can be self-fulfilling. If a central bank is following good policies like the BOJ's, we can eliminate default fears, even if we have a debt-to-GDP ratio that is high, not infinitely high, but within limits. If a central bank is following relatively bad policies, as the ECB is following for, say, a country like Italy, then we can have default fears that are unjustified, even though evaluated with a safe rate, a country may be sustainable. So yeah, we need to be doing the risk evaluation carefully, and in cases where we have multiple equilibria, as we do in government bond markets, we need to make sure that the central bank operates so as to reinforce the good equilibrium and not the bad equilibrium. Let me stop here because I think this is 5 Mediterranean minutes already, I think.
No, it was even 5 German minutes, so it's really, really excellent. So, Esther, please.
So, very briefly back to Guntram. Yes, I mean, so Athanasius before said that Bank of Japan is not doing exactly right based on textbook, but what I'm saying is that is textbook right? That's exactly the point. So all this paradigm is based on the fact that there is a Phillips curve that depends on short-run output gap, while what I'm saying, or actually I'm not, again, the only one, is that this lag has changed, meaning that the bulk of the long run, so globalization and automation that affects the labor market has grown enormously. Why is participation important? Because, see, you might be seeing unemployment falling down and you might be claiming that, you know, the Fed has been doing the best policies ever, but maybe participation is falling down because nobody else is working. I mean, nobody else is entering the labor force. So the question is, I mean, if there is underemployment, if there is feeble participation, if there is discouraged works, then the measurement that you have there to judge the monetary policy is not the right one. Regarding low wages, I mean, to start the Keynesian mechanism, you need to have that part of the stimulus that you put has to go to workers. If all the stimulus, and this is about the inequality effects of monetary policy, if all the stimulus goes to pump up asset prices, and this goes all into the markup of the large corporations, and the wages stay very low, then basically demand doesn't pick up. So again, I mean, monetary policy is pumping asset prices, but basically with very low effect on output, because the Keynesian mechanism doesn't even start to start with. Regarding risk, what's wrong with risk in the economy? I mean, first of all, as I said, there is a lot of micro evidence on the fact that, expansionary policies producing, tail portfolios and excessive leverage. And I myself had done this, and also most importantly is increasing things like delta covar, which is a systemic risk measure. But what is wrong with risk? I mean, normally you think that it should be diversified because risk comes with default. So if it is not well diversified, then we might want to subsidize people that go to the roulette and think that people that go to the roulette increase output. I mean, what is healthy is that you have risk but well diversified, not all into unproductive kind of activities.
Thank you very much. It was even less than, it was just 3.
Yes.
Actually, since Esther is giving you that extra minute, there was a couple of questions I did not get to. First of all,
just to increase gender disparity.
Thank you. It was on central bank coordination and on what would have happened if the BOJ had started doing QE in 2008, which I think would have been wonderful. First of all, had the BOJ started to do a QE in 2008, that would have encouraged other central banks, the ECB and the Fed in particular, the big ones, to do more, which the Bank of England started doing shortly after. So I think we would have gotten to a better outcome earlier. So this is my first answer. It would have been much better if the BOJ had started in 2008. In terms of coordination, I don't think coordination of the major central banks can be forced. But I think that if each major central bank is really focusing on maintaining price stability in the territory for which they are responsible, we get pretty decent outcomes already. So the BOJ would have been saying we need to raise inflation. The Fed was already doing that in 2008. Because we need to raise inflation, they were easing. The ECB, they would have had to ease more if the BOJ eased. So we don't really need, strictly speaking, coordination if they all do what is best for their own territories. Had that been done, we would have done more easing earlier in this crisis.
And now, Benoit.
Yes, I don't think I'll take 5 minutes. I just want to say I'm super grateful to Athanasios for being so supportive of the policies that we've run in the Euro system. Actually, I think with some twist, little twist. And here I'd like to invoke, I think it's appropriate, Nobu Kiyotaki. So if you ask Nobu how monetary policy works, you do it with QE, you do it with short-term interest rates. Basically, you pop up asset prices. And if you look back to this particular episode that is 2012, you had this beautiful graph with balance sheets. But what has happened in the summer of 2012 is that the Euro system and Mario Draghi, for that matter, has announced the OMT program, which you can think of as an off-balance sheet commitment that has been extremely effective in terms of asset prices, a point that Francesco stressed earlier, and the spreads within the Euro area have collapsed from very high levels to very low levels after this off-balance sheet announcement of the OMT. So that's the first way, I think, that you've been supportive of our policy. The second way you've been very supportive of our policy is that you've stressed the importance of comparing the nominal growth rate of the economy to the nominal interest rates. And near the end of the slides that you presented on Italy and Germany, it shows that in the case of Italy, you have a nominal growth rate of the economy which is now higher than the nominal interest rates. So I think that's great support for us, and I'm very grateful. Now moving to the two questions I got from my Bruegel colleagues on Slack and how you want to measure Slack and take into account the changes of the labor market. If it's immigration or an increased participation of older workers, you just increase the output capacity in the area. So in the area that you consider. So it may be immigration, but which is pushing down wages in Germany, but it just means that you want to have higher demand, that you can sustain a higher non-inflationary demand in Germany.
Absolutely.
So I think an area which would be extremely interesting for Bruegel to look into is to try to get into the mind of the people at IG Metall and IG Farbe who are basically not doing their jobs. And that's a point that the president of Bruegel, Jean-Claude Trichet, is making very convincingly, in my opinion. You have a very high current account surplus. You have a very low unemployment rate. You have workers coming from abroad, or they are older and they used to not work and now they work. And yet you have the people bargaining for wages in Germany. You know, it seems they have not understood they are in a monetary union yet, and they're not asking for higher wages, and that's a place where we need structural reforms actually for the euro area to function better, and I'm sure that Bruegel can be leading in this respect. Another point I want to stress in those econometric regression I was showing you. It's difficult to estimate Phillips curve, but when you add up, when you add up basically observations by making panels of countries, and this is also what the IMF is doing in the forthcoming World Economic Outlook, or as I presented you today, you see that slack has a very significant effect on wage inflation. Okay, so you don't fully explain the variance of wage inflation across country and across time, but you know, your starting point, this Phillips curve, you cannot reject the hypothesis that it is still there and functioning pretty well. Okay? Unemployment has a very large and significant effect on wage inflation across OECD countries, across euro area countries. It's still the case. It's difficult to estimate at the country level, and here we may be over-influenced by work which has been done on the US economy, but the world is not reduced or limited to the US economy. We are grateful that we have more countries and observations we can test hypotheses with. Thank you.
Thank you very much. It was 4 minutes and 55 seconds, so exactly on time. Now, Kosuke, please.
Thank you. So you asked me about the balance sheet size of the consequences of the balance sheet of the BOJ. And actually, I haven't done any research on this topic, but let me refer to a very nice paper by Fujiki and Tomura. So Fujiki was an economist at the BOJ, and they estimated what's going to happen to the BOJ balance sheet after they start increasing the rates. And I don't remember the exact numbers, but the main message I remember was, I think the loss was not so large, but not negligible. But that's a very nice paper, so I recommend you to read that paper. Okay. And sorry that I don't remember the numbers, but and risk-taking. Okay. So I think I agree with Esther. So Japanese banks, commercial banks, have been criticized by not taking risks. And in that sense, what I find by risk-taking channel is I don't think this is a bad situation. And risk-taking is bad as long as it imposes systemic risks. Okay. And finally, so let me also mention about the difference between the US performance and the Japanese performance. And as Athanasios says, the Japanese economic performance after the collapse of bubble was quite slower than the recovery in the United States. And I don't deny the role of monetary policy, but also I think capital injection was as important as monetary policy because it is very slow. Capital injection and stress tests in Japan after the collapse of bubble was very, very slow, and a sequence of insufficient capital injections. And I think that also contributes to the slow adjustment of the slow recovery of the balance sheet of the private sector. And I think in order to assess the performance of the efficacy of monetary policy, we should take into account.
So thank you very, very much for all of you in the panel and also all of you in the room for asking very tough and good questions and comments. I don't think that there is a general agreement among all of us how effective QE has been in Europe and in Japan. But I think we had an excellent discussion. I learned a lot. So let me just upload, and we have a short